Hey everyone, thanks for tuning in on episode 3 of the Gitlit podcast. This is actually the first time that we're doing a video recording. Um, so excited to start doing these. And with that being said, let's dive right in. Um, so for today, what I wanted to talk about is around fundraising as a early stage startup. So, if you've listened to the last two episodes, we've talked about everything from, starting a business, is my idea worth building technology for, and finding your first customer. And, if you've gone through that, you've found someone who's willing to pay you for a product or a service. Um, or you are at a place to, you've made a decision that, hey, I want to build the product and start a business and I want to raise money. And what that means is there's kind of two sides. There's two sides to this. One of it is, am I a lifestyle business, which would mean this episode's not for you. That would be related to towards, just starting it yourself, funding it yourself. You're not taking any investor dollars, and you are growing that business, and you're going to have it forever, and just grow it organically. The flip side of it, which for what this episode is for, is related to you are actually starting a startup that is going to attempt high growth for a high return, and you need investor dollars to do that. So, you know, what does that look like? Um, Many friends I've talked to, related to if they're engineers, developers, technical people, they think, oh, well, I don't have an MBA, I don't have, um, I don't know business and all that, and that's okay. Fundraising is a whole different ball game in itself, and really there is no. I mean, some colleges have entrepreneurial classes, but outside of that, nothing prepares you for asking people for money. And so what I'd like to do is just go through this episode, talk about the two sides of raising capital for early stage companies. So this is really from the grounds up, just getting started, just getting by, building something to take on to scale. So the first really the first thing I wanted to talk about related to raising uh, funds is around the friends and family deal. So first things first, when you have a startup and you are going to raise capital, typically what you see is you have a very, very early, which is friends, family round. And then the next stage of that is angel investing, which is also typically called a pre-seed round. And then from the pre-seed round, what you would have is a seed round. And a seed round gets more venture backed. Sometimes there are a few angel investors that will invest in seed rounds. But for this conversation, I'm focusing on the friends and family round and then the pre-seed round from angel investors. And just a little background, friends and family means you are going to your family, your friends, cutting them a deal for some money. And then angel investors are people who are investors, meaning they have a high net worth. I think legally it has to be, I think, over 250K to be an angel investor. That could have changed. But so focusing first on raising capital from friends and family. And this can be a good place to start. Backtrack. For my startup, particle space, real estate technology, I actually did not do a friends and family round. What I did is I bootstrapped myself. And if you're listening to this and you're technical, you know exactly what I mean. You coded it yourself. It's a weekend project. And, um, and put my own investment in it as far as my time and energy in building that. And then what I did is I started going through finding product market fit, and then I built a pitch deck, which I'll talk more on that. We might even just do a separate episode on that. But I went through and found some early customers, some adoption, and I was like, hey, listen, I feel like this is an opportunity worth pursuing and something that I think can really scale. And so what I did is then, instead of going friends and family, I went more institutional, looking for angel investors of high net worth and saying, hey, here's an opportunity to invest in this startup. I'm looking to raise, $600,000. Here's the deal that I'm cutting. Would you be willing to write a check? And um, and that's how I went. But coming back to the friends and family, I do know many friends of mine who have startups that did that. So they pitch their family, they're supportive, or just friends in their community. And they got anywhere from 500 to $3,000, maybe even more, just from money that they were able to pool. And um, from when they give you money, it is, on your end, you have to structure some sort of deal for them. And what I mean deal is you have a convertible note, a safe, um, something that legally binds, your agreement between your friends and family, so that way their cash will turn into equity, um, or is equity. And I don't think we'll dive too deep into that in this episode, just because it's a big conversation, what different deals look like. But in just a high level, typically there's two types of deals that you'll see. One of them is convertible notes, which are more common in the Midwest. In your coastal cities, doesn't really exist. Mostly safe notes. Friends and family, you see it a lot though. It's pretty much a debt receipt that says, hey, if you give me $10,000, this receipt is going to convert at a discount with an interest rate based on your company's evaluation. And then you have safe notes, which are more focused on the founder. It's just very straightforward. You have a discount at a pre-value or post-money valuation, which again, we can have a separate conversation on that. But friends and family, it's really just pitching your family. Maybe you have a rich uncle, maybe your sister wants to give you $500, and you take that, and then you have some sort of agreement in place that states that, hey, for this $500, $1,000, it will convert over into equity at a discount. And so then what you would do is, when you're raising that friends and family, a lot of times you will have a product, or you'll have some sort of put together kind of service, or maybe you have one or two one-off customers, or maybe you're using that money to build a product. Typically what I've seen is, if you're coming from engineering background, which is more common in your coastal cities in America, a lot of times they'll actually build a prototype. You'll have a lot of tech founders who will just build it themselves, and then they'll use that cash from their friends and family to kind of fund some of the marketing or some of the designs, or the hosting to run a service or a technology product that they have. And then from there, really that goal in mind is that you're using that early stage, either one, build a product, or prove it out. Kind of both go hand in hand. And as you go on that journey of doing that, what you'll see is, you'll be able to make the pivots, you'll be able to make adjustments as you go along to, find your product market fit, find where, is my service working? Is it is it functioning? Is this something that I can scale this company? And really, you want to use that friends and family round to focus heavily on your um, really just proving out your idea, vetting it out, and seeing if you can land some customers, seeing if you can land um, some deals in place. And really, what you would do from there is the next step would be for you to start seeking a little more institutional and or just angel investors, which leads me then to your pre-seed round. Um, so friends and family, again, it's very light. It is you testing, proving, building something very, very basic, using some sort of online form builder, Airtable, something to get potential customers feedback, and or you just bootstrapping it yourself. And you have one or two users and you now have something, some sort of business that you can share to investors about an opportunity. So really what I'd say is knowing your customer. Don't just assume right now, so right now with where this conversation, in this day and age where this conversation is happening, with what's going on in the world as far as funding, cash is king right now. As it's getting a little harder to raise capital. But there's still a lot of movement on the early stage. And if you have traction and if you have a proven business that you're showing that, hey, with this money I'm going to be able to take this company to here, then there's plenty of cash for you to capitalize on and get investment from. So what I would do is focus heavily on that early stage, whether you're raising friends or family or you're just doing it yourself, and trying to prove out your model. Focused on acquisition of your customer, understanding your market. Can you sell your product? And as tech people, the last thing we're thinking, oh, I'm just going to build it and I'm going to let someone else sell it. False. Do not do that. You will waste so much money, so much time, because no one is better suited to sell than the founder themselves. So, and if you're not willing to do that, you probably shouldn't start a startup, because you're just going to waste precious time and dollars, because you're going to go around this big circle and come back to that conclusion. And that could have saved you years of your time or months of your time. So, this pre-seed, this friends and family round, or, you individually, building this out, it's very critical for you to, understand what you're selling, what you're doing, and talk about the return. Do what you can to prepare to go and pitch investors, and start with your family. That's a great place. Whether you take cash from there or not, pitch them your idea. And, with that, come out of that stronger with a better idea. And you don't need to have this huge, perfect platform ready to go, this perfect app. No, I would actually say don't build, validate, get customers willing to pay you to build, use that to raise money to build, and pay yourself to build, or, pay others to build with you, from the funding that you get. And the reason why I say that is, if you put the customer first and you focus on your market first, as you go through that discovery, you're going to save a lot of time, because you'll be able to identify market fit, identify the scaling, identify what works, what doesn't work, versus focusing on the product first and unsure if someone's going to buy it, and then you needing to go back and adjust the product back and forth. So that's why, focus as heavily as you can on your customer and your market, and don't assume anything. Get feedback. Until someone's willing to put their card information in and pay you, you know, that's really where you want to focus. So anyways, you've raised some cash from friends and family, and you got a little MVP out of your product, minimal viable product, something that's usable, clickable. Maybe it's just a website builder, or it's just an Excel sheet, and you've talked to people and you have signups, or you have shown something, whether it's one transaction, a payment, whatever. And now what you're going to do is say, you're going to take that idea, take that minimal product, whatever you have, and you're going to then take that and pitch it to investors, angel investors, for a pre-seed round. So really the beginning of everything starts with that pre-seed round. And this is, typically, this is only angel investors. So I've known people that actually skip pre-seed and actually start at seed and raise 1.5 to $3 million from a single investor, an institution, somewhere around those lines, for just a straight safe note. That's a little different. We're not going to focus on that at all, but I've seen stuff like that happen. But as far as that next stage of things, we're looking at a pre-seed. And there's kind of, if you're not based in the Midwest, more than likely you're going to have safe notes. And so with safe notes, that's just the most common thing. Expect that and prepare that. And this is where you kind of need to start understanding a little more about the deals, how to pitch, how to just create some basic financials of your business and show, where things are going to trend, where's that hockey stick of growth that happens, in the next 2 to 5 years, your EBITDA, your TAM, SOM, TOM, like there's all these different little financial terms that we'll cover in a different episode at some point. But, really what you're doing is you're going to a group, you're going to an individual, and you're saying, hey, I have this idea to build this app. And here's exactly the problem. Here's how we're solving it. Here's the market opportunity. Here's the traction I have right now. And here's the money I'm looking for that is going to get me to this stage. So I think more than anything, it's not just sharing, the detail. It's a story you need to tell. So when you're talking to the investors, you're pitching them, you kind of want to know how to short and sweet, straight to the point. Like, I'm looking for $200,000 right now, and this is going to help me get to 5 to 10,000 in monthly recurring revenue, to help me get to the next stage, to raise an additional extension round on an additional 500,000, which will then lead me to get to 50,000 in monthly recurring revenue, which then is going to be used to drive into raising a seed round for 1.5 million. And, you're saying all these numbers, but you need to back it up with support. And I think that's where, when you're talking to these angel investors, they're buying you. Yes, they're buying the product, but they're buying you. You, the founder, are the one they're believing in and trusting in this to deliver and execute. So no pressure, but there's, at the end of the day, they're paying into you, right? And your execution, because it's all on your execution. And so really the key things that you need to get across the table is, hey, here's this idea, here's how I found it, and then here's how I started solving it, and here's what my customers started telling me, and here's how we're gonna acquire these customers. And so really just show them something very simple, solid, straight to the point, about your business, and then talk about how much you're raising. And it's okay if you don't have like a sheet, like a financial a deal already cut. Like they're probably going to ask, are you raising a safe convertible note? Really, what you could do is just plan on a safe. Again, if you're in the Midwest, you might have some people that want convertible notes. I personally did mostly convertible notes. So, but for mostly everyone, it's always going to be safe. And that's really the new trend. And you could just go to ycombinator.com or just do a quick Google search for a sample safe note. Typically, it's going to be like a 3 million pre-money valuation. I think the staple that everyone takes is your company, the standard Silicon Valley number that a startup gets value to is they just say 3 million, 2 to 3 million. And so you can just take a generic safe note that has, some sort of pre-post money valuation, have a specific discount. You could just follow some sort of standard basic. And then from there, just, you could send that to them after you pitch. If they ask to see this, they might even have their own safe note that they want to do. But again, I'll save that for a later conversation where we can talk about all the different deals for capital raising that are available. And so, but again, when you are raising capital from angel investors or angel groups, there's kind of two sides to this. There is the relational side of like a individual person, or there is the group setting where you have angel groups, which is a ton of investors kind of in one organization that all put in money, and then you get one single check. So they're both great. Individuals are always nice, especially if they have money and they're in your market and can connect you to a lot of people. That is always very valuable. I think something you want to think about for angels, though it's not as important, are who are they? What is what kind of, community do they have? What kind of network do they have that could benefit you? And then also, and that's where an angel group can be very nice. So kind of a single organization that has a ton of just angels a part of it that do investment through the group, that's usually nice as well because they're well connected, and they can write larger checks. But an angel investor typically writes anywhere from $25,000 to $50,000 for one check. So if you're raising $200,000, just get those either from one organization, or get a few investors to come together, and then they could form a LLC, some sort of company, and actually invest through that. Which, if they're an angel investor, they are going to have some sort of verticals that they go through on this. So, but yeah, so really where you can start is you have friends and family. But when you are going for a pre-seed round, typically you're going to raise under $1 million. That's normal. And when you're doing that and you're pitching investors, angel groups or whatnot, my recommendations would be to, don't come in there, be honest, ask of course for feedback. For the most part, you're going to be said no to. That's going to happen most of the time, but you have to get through all those no's to find a yes. So, unless you really have a solid idea and traction, if you have proven, if you have customers and you're scaling and you're proving it, that's a done deal. Again, cash is king. And if you have monthly recurring revenue before you've raised angel investor dollars, that looks even better. So that's why, if you can do everything on your part, have customers, have, some sort of usage growth, and be able to share that story of how you acquire customers, how you keep them, and where you're going. You got to sell the future because they're giving you money because they want a 10x return. So, you need to pitch them on why they should invest in you, what the opportunity is for them. And, as you go through that, they're going to, more than likely they'll say no. Well, do not ever burn bridges. Add them to, do biweekly, monthly investor updates with showing, hey, here's my meetings this week. Here's my cash flow. Here's how much I'm doing monthly recurring revenue. Here's a new contract, whatever can show traction, users, whatever it is. And, you know, add them to your investor emails that they get every month, every other week, every week, whatever you want to do. Um, I went through Generator Accelerator, and they invested in us. And what they actually ended up doing was having us do weekly investor updates. And so that was nice because it really kept you accountable. And so if you add those angel investors pitches that said no, well, you don't know in the future. They might come back and say, hey, is there still an opportunity to put 25K in? And so doing that, build those relationships and always ask, don't be afraid to ask for help. I think you want to build a community and you want to build the network of people who know you and trust you, because even if they're not interested, they might have people that invest in certain areas. A big part of it is, one, it's really just finding the right partner, the right person that believes in your industry, likes it, and you and what you're doing. And so, yeah, be you, be honest. And do whatever you can to know your business, know your customer, know your market, and share that opportunity, because that will go a long way. And but yeah, so the angel, the pre-seed round, individuals are great, groups are great. It can be a little faster going individually if you're able to maybe find individual give you 25K, 50K, or you can do it in chunks over time versus just one big check. Angel groups can tend to take a little bit longer. So if you're short in cash and you have, for example, you have a short runway, 2 months left before you're out of cash and you have to shut things down, well, you might be able to find an investor for 25K, extends you out a little bit so that you can get the rest of your, 175K out of that 200K you're raising from an angel group, since it takes a little bit longer. But yeah, so that's really the takeaways on for my, that come to mind for me, or in longs of raising capital for early stage. Again, you have those that friends and family round, which use that as not a playground, but really vetting things out and getting things started, and whatever you can do to focus and find your market, your product, your niche, and understand your customer, that will help you when you start going to angels for your pre-seed, because one, it can help you get a better valuation for your company, especially if you have revenue already, but it just shows that you know your stuff. And when you know your stuff, people feel confident, and investors feel like, what, this is, this is possibly a good investment for me. I love this guy, solid, good numbers, even has some monthly recurrent revenue. If you can do any of that, again, you do not need that. I do want to make that clear. I know maybe not most, but almost half of startups that start, they're just getting started. They don't have a product. They just have an idea. They have some people maybe on a list waiting to get signed up or logged in. And so, what I'm trying to get across is that if you go the extra mile ahead of time, that can really greatly improve your chances of getting a check faster, but it'll also help you in the long run as far as like valuations go for your business, which is always a good thing as well. So with that, though, I hope you found this helpful. Raising capital it's a challenge asking people for money. It's like raising support almost. You're saying, hey, can you help me? But instead, it's the opportunity here. You're saying, hey, listen, I have this amazing idea. It's going to get you a 10x return. And here's exactly how it's going to happen. Here's my customers. Here's my traction. Here's the problem I'm solving. And, here's how we're executing and how I'm going to acquire customers and scale this to the next step. And, I think just in closing, what I would add is know where you're going and think 5 years from now. Because an investor, if you can share the present, the traction, and the growth you're hitting, they're going to ask you, where are you going? What's your exit? And so, because they want that 10x return. So you have to answer that. You have to know that, hey, here's the opportunity of other companies that have been acquired like me, and don't think there's no one like you, because that's not true. There's always some sort of competitor, someone you can compare yourself to. So find something that is as similar as possible. Look at acquisitions online that have happened. This company exited for 10 million bucks and was acquired by this company. They want to know that. Share that with them. Share, hey, in the next 3 to 5 years, 5 to 7 years, we're looking to be acquired by these types of companies for this amount of money, and you can leverage the past history to support that evidence. And so, one, sharing where you're going when you get acquired, how you do it. But second, what's the next step? They're giving you money, and don't just say it's to increase sales. Like, no, where does that get you in sales? Around where? And if that goes well, what do you do next? So in most cases, it would be, well, I raise this 200,000, which is going to get me to 15K in monthly recurring revenue. At that point, I'm going to look to raise a seed round of 1 million, whatever that might be. And what you're doing though is showing that, hey, you have a step to get to those next stage, to get to that acquisition. So I hope you find that helpful. I really do appreciate tuning in to the Gitlit podcast, and I look forward to talking to you in the next episode. Thanks, guys.